investing in property makes sense. Investing in the right property takes knowledge. Welcome to the Rewarding Property Decisions podcast. I'm Jarrod McCabe, Director of Wakelin Property Advisory. Join me for expert insights into the fundamentals, trends and opportunities to help you create long-term wealth through smart property decisions. Hi everyone, and welcome to episode 71 of the Rewarding Property Decisions podcast. So today we're going through part 2 of our 2024 property report. So we wanted to cover off on another of the major factors which we feel will influence the property market this year ahead, and that in this instance is interest rates. Now they've certainly influenced the market, particularly over the last 18 to 20 months, potentially for differing reasons than what we hope how they may influence it going into the new year. But I thought no one better to talk to on these topics from a financial perspective than Stuart Weems. Thanks for joining me, Stu.
Hey, Jarrod. Great to be back with you.
So we'll get straight into it. How have you seen things from a last year, 2023 perspective, and how has the financial sector influenced the property market from your point of view?
Well, it really comes down to affordability is the element, not so much interest rate settings per se, but really the affordability as the result of interest rate settings.
Yep.
And that's a lot of commentators, particularly economic commentators, don't understand the nuance of that. So sometimes people think, well, in a high interest rate environment, property prices will fall, and the reverse is true as well. And that can happen, but it's really mostly about affordability, because more than 50% of property-based decisions are made by owner-occupiers. So it's unlike, share markets or whatever, when people can commentate on share markets and also draw conclusions around sort of share prices and interest rates. That's fair enough, because firstly, there's a lot of data with share markets, a lot of reliable data with share markets, but not so much with property markets. And secondly, most decisions in share markets are based on financial fundamentals. There's a bit of emotion in there, of course,
yeah.
But and so they tend to take the same approach when talking about share markets and property markets. But we have to remind ourselves that most property decisions are influenced by a lot of lifestyle factors, schools, family, being close to family, all these situations. And then also, when people contemplate buying a family home, they're mostly contemplating living there for a long period of time. Could be 10 years, 20 years, whatever it might be.
It's usually not a short-term exercise, is it? Well,
it's not a short-term exercise. No, and they're not trying to arbitrage prices or, sell when interest rates are high and buy when interest rates are low or any of that sort of stuff. So it's really about affordability. Can I go and buy this house? Can I afford to meet the loan repayments and then eventually repay the debt or exit the debt in some other way? That's the decision making. And so interest rates certainly play into that. But most people, when they're going to go and buy a home, they're going to realise that interest rates will change over time. So really the biggest impact then isn't really the current interest rate of the day or what we might expect, how we might expect interest rates to change over the next few months. It's really around borrowing capacity.
Right.
Can I access the funds to be able to buy that property? If the answer is yes, can I afford it? Is it prudent? All those sorts of questions. If the answer is yes, then buyer demand will be strong. If the answer is no to either of those two questions, then it'll be weaker. So it's not really necessarily about interest rates.
Yep.
It's more so about borrowing capacity.
And that's changed fairly dramatically, not just as you said, with the interest rate rises that have occurred in the last 18 to 20 months, but basically far back as 2016, 17, when we had the Royal Commission and things from what you've said in the past.
Yeah, that's right. I mean, there's two things that have occurred over the last year simultaneously that have never occurred previously in Australia's history. The first one, obviously, is rising interest rates. That's not new. And in fact, interest rates have been higher than where they're set today. We only have to think about sort of around the GFC time and also early 90s, but they're at elevated levels. The second thing that's happened at the same time is the focus on living expenses. So previously, if you look back, both of those previous occasions where interest rates were as high, if not higher, so again, GFC and early 90s, when banks were looking at borrowing capacity, they were using benchmarks for living expenses, and those benchmarks were really conservative. In fact, arguably meaningless. They might assume that a family of four spend $40,000 a year on living expenses, whereas the reality is it's probably twice that amount.
Yeah.
And so what it did is kind of overstate their borrowing capacity, if you like. So that sort of offset the higher interest rate environment. Whereas today, as you said, since the changes that APRA pushed through from 2015 onwards, banks will look at actual living expenses. They'll ask you to declare what you're spending, and then they will verify that looking at bank statements. And so the two things together, it means now we have to base borrowing capacity on spending $80,000 a year on living expenses, and overlay on top of that higher interest rates, is really pull back borrowing capacity substantially. And we know that there's a strong correlation between money flows into the property market and capital growth. And so if you reduce the amount of money flowing into the market, you're going to reduce capital growth rates.
Yeah, of course. Interesting you say that, though, the money coming in. I think I've heard you say too that the amount of investor lending, based on even these sorts of things, you would expect it to have been down, but it's actually been improving late last year. Is that right?
Yeah, it has. Investor lending rose quite considerably in calendar 2023, but it was off a pretty low base.
Okay.
That during COVID was really dominated by owner occupiers.
Correct.
And mostly higher income earning owner occupiers. People that sort of preserve their employment, preserve their cash flows. In fact, their cash flows were greatly improved. And then they took the time to say, well, if we're going to be trapped inside our homes, let's have a lovely home and maybe upgrade it. A lot of that was going on. That was driving a lot of the data or the market and the market sentiment. And then obviously during that time, that COVID time, landlords had to give renters, rent abatements or reductions or holidays or whatever it might have been. And so investing in property at that point wasn't particularly attractive. It's all about how can I improve my standard of living during this lockdown process, particularly in Melbourne, of course.
Yeah. So if we're looking into 2024 then, in terms of affordability and borrowing capacity, is there likely to be any signs of easing there, do you think, or is it going to be similar to last year?
Look, there's a couple of changes that can be pushed through. They're going to have an impact, and to what extent it's going to depend on people's individual situations. But obviously, stage 3 tax cuts being pushed through from 1 July onwards. That's going to obviously increase people's after-tax incomes, and that's going to have an impact on borrowing capacity. And one thing we must realise is that borrowing capacity be quite sensitive to these sorts of things, because once you've covered your living expenses and had enough income to meet existing lending commitments, then any additional dollars beyond that go directly towards increasing borrowing capacity. So it can actually be quite sensitive. It could make a sort of 5 or 10% difference from a borrowing capacity perspective.
Yep.
Then you've got potential interest rate cuts, and I think, I think there's some anecdotal signs to suggest that interest rates are really starting to bite. And perhaps we were all a little bit surprised that that those signs weren't present before now. But of course, Australians had a lot of savings, about 10% of household income in savings, and so they had to kind of eat away at that. So markets are predicting 2 rate cuts in the second half of this calendar year. And I think looking at the signs around inflation and just how busy things are, I think that's likely. At the beginning of this year, I was a bit sceptical.
Okay.
But after the first couple of months of this year, I think it's actually quite likely that interest rates will start to make their way down in the second half of this year, and that will obviously improve borrowing capacity. And the third possible change could be changes in credit policy. So that is that maybe the regulator or the banks will say, well, actually, maybe we don't need to be using a benchmark interest rate of 9.5% to test whether someone can afford to borrow new money. Maybe we can use a lower benchmark. I think that might happen. The lenders are playing around with borrowing capacity a little bit over recent months, and they'll do that covertly. They'll change their calculators a little bit, but won't publish what they've done.
Yeah.
But we have noticed a slight improvement in borrowing capacity. I think that will continue, but I don't think there's going to be any really overt changes. That is the government coming out, for example, and saying, look, we're going to dramatically change borrowing capacity. I don't think politically, I don't think that's going to necessarily be a positive thing. But I think the regulator and the banks will play behind the scenes. So I don't think there's going to be one thing that's going to improve borrowing capacity. I think it's going to be two or three different things over the course of this year. And I think that will improve borrowing capacity. And of course, for people that are in a relatively sensitive situation in terms of, very tight borrowing capacity, that could have a big impact. So that could mean the difference between them not being able to execute on their plans and being able to do so.
You mentioned the benchmark rates and things, and I think I've heard you say before that you feel that's one of the ways that it could open up and get more investors into the market, hopefully to ease a bit more pressure on the rental side of things as well, potentially by capping that rate. Is that something that you think's a good thing to do?
Yeah, I mean, it's definitely got to be capped, right? So just for listeners, banks have to add a buffer, a cap on top of your current interest rate to test to make sure that, can you afford the loan even if interest rates increase? Now, of course, that's really important when interest rates were 2 or 3% because everyone knew they were never going to stay at 2 or 3% forever. But when interest rates are, sixes, almost 7%, depending on if it's owner, occupier, or investor, you probably don't need to add a 3% buffer. And so I think the 3% buffer should stay, but there should be a cap. And maybe that cap should be 8.5% or something like that. Just to be realistic that, it's unlikely, very unlikely, in fact, given the level of household indebtedness, that interest rates in Australia would ever be above 8%, mortgage interest rates would be ever above 8%. And so I think introducing something like that would be wise, but I don't think the regulators are going to do it given current lending volumes. Lending volumes aren't too bad.
Okay.
The problem, however, is that a high interest rate environment and a tight borrowing capacity environment, what that does is it locks out middle to lower income earners. And very wealthy people with very high incomes aren't impacted whatsoever.
Yeah.
And it worsens wealth inequality. So I think we need to do something. We need to have a policy that mitigates that. And it needs to be changed, but whether it will be changed this year, I'm unsure.
Not sure, yeah. Is there anything specific that you would advise, and again, this is obviously very general, so if you need to seek specific financial advice, you should do so, but that investors could do to help navigate that affordability, capacity side of things to help them potentially get into the market sooner?
Yeah, I think there's a lot of things that investors and property purchasers can do to maximise their borrowing capacity. And I think it's really important to realise or acknowledge that borrowing capacity is the scarce asset here, not necessarily property.
Yep.
I mean, property, good quality investment grade property is by definition a scarce asset. There's no doubt about that. But if I had a bottomless pit of money, and I was quite diligent over the course of the next number of years, I'm sure I could find enough good quality assets to invest in.
Absolutely.
So that's not really the scarce asset. The scarce asset is borrowing capacity. Everyone has their own maximum borrowing capacity, whether that's implemented by the banks or whether that's based on my own risk profile and cash flow position. But either way, we've got a maximum. And so it's about then allocating that borrowing capacity as effectively as possible. So that is, I'm going to get the best return for the dollars invested, and also taking steps to safely maximise that borrowing capacity from time to time as well. And there's a few things that you can do to do that. And the biggest one is obviously go and speak to a good mortgage broker that has plenty of experience in looking after people in similar situations to you, because they will know all the tricks and traps and the best lenders to use and all those sorts of things. But some things that we've been doing for clients is resetting loan terms is a big one, particularly for investors. So when you go and get an investment loan, it's usually a 30-year loan term, and you'll have an interest-only period. And normally that's 5 years.
Yep.
So really the loan term is split 5 years interest only, 25 years principal and interest. Then what normally happens is after that 5-year interest only term, people normally roll over onto another interest only term. That's fine. That's all well and good. But at the end of that second 5-year interest only term, their remaining loan term is now 20 years, which is a relatively short period of time, which is going to do two things. It's going to reduce your borrowing capacity because now you've got this commitment that you've got to repay over 20 years, not 30.
Yep.
and it will increase your repayments, of course. So by resetting the loan term, either with your existing lender or a new lender, back to 30 years, it improves your borrowing capacity quite significantly, particularly in a market where borrowing capacity is quite sensitive. And it will help minimise repayments as well, because a lot of investors now, Jarrod, are thinking about repaying principal interest on loans rather than interest only, which, depending on your situation, isn't necessarily a bad thing to do. And it will save you about 0.5% in interest costs as well, because lenders offer lower interest rates for P&I loans.
Yep.
And so resetting loan terms is actually quite good. The second thing we've been doing a lot for clients is more and more now banks are relying on desktop valuations, property valuations. So desktop valuation is produced by a statistical valuation modelling tool, as opposed to a valuer driving out to the property, inspecting it, et cetera, et cetera.
Yep.
And normally those desktop valuations have been quite conservative, but over the last few months, for whatever reason, sometimes they've come in well above expectations. And that's good, because that means that borrowers have a lot more equity, which means that they've got a lower LVR, which means they can get a lower interest rate, or they can borrow more. So they're the two things that we've been really working on lately that you can kind of play with a little bit, depending on individual circumstances, to extend your borrowing capacity.
Yeah, that's fantastic. All right, that's great advice. Thank you very much, Stuart. That's probably enough for today. So thanks, everyone, for joining us for episode 71 of the Rewarding Property Decisions podcast. Now, if you'd like to get more information about Stuart and his team, their website is prosolution.com.au, and I would advise everyone very strongly to have a listen to Stuart's 2 podcasts. He's got Investopoly, or with his colleague Mina Abram, The Holistic Accountant, both very good in terms of providing you some fantastic insights on the financial side of things, but particularly in Investopoly's case, on the property market as well. So thanks very much for joining us, Stu.
Thanks, Jarrod. It's always great to have a chat.